All righty, we'll get started here. So good morning, good afternoon, or good evening, depending on your perspective on the world. And welcome to Trading Coaches Playbook. My name is Brandon Wendell, Charter Market Technician. I'll be your guide as kind of go through the markets for 2023. Yeah, some of you know me, obviously. Well, you probably wouldn't be here if you didn't know me, unless you just you come every week to the Trading Coaches Playbook, I wouldn't blame you. There's a lot of good information that's put out every week. We have different rotating coaches that come through, Tony, myself, and a few others. Anyway, so before I kick everything off, just to remind you, we're not broker dealers or investment advisors, gave up that licensing years ago. So we were looking at the information here from an educational standpoint only, not telling you to buy, sell, or holding particular securities or giving any personalized recommendations here. And you mentioned, again, it's not a recommendation, and we're just, we got to keep in mind, there's always risk of loss in the markets. No matter what we do, we can never eliminate the risk. We can just try to manage and limit risk. And we are also not subject to trading restrictions. We got positions in securities or initiate one at any time. So welcome, Karen. Welcome, Helen. Good morning or good afternoon. Just clicked over to afternoon for me. No, that's okay. Anyway, you can see we got a bunch of premium online workshops. I'm actually pretty busy with the program called Wealth with Spreads. That's one of my programs, which I've been doing for a couple of years now. I just released the numbers on Twitter and everywhere for the year-end results that we had, and we're pretty successful. So I'm actually working on that video today where I teach you and show you how to trade future spreads. So I'll talk about that a little later if you want. There's obviously a lot of other workshops going on. I also run what's called the E-mini Think Tank, and the E-mini Think Tank is kind of what it sounds. We get together, we talk about trading the E-minis, the futures markets, and how to do it properly. And again, I released the recent numbers for the year 2022 and had a very successful year, hoping to continue that streak. So you can stay in touch with us. We're pretty much everywhere online. I also have my own Twitter, my own Insta, things like that. So you can keep in touch with me if you want individually. I'm at Trader BDub on Twitter. I'm pretty active pretty much every day. So again, got all the links there. And thank you, Robert. Yeah, there were some pretty impressive numbers on all the programs. Good morning, Kevin. As you can see, I trade 3 days a week in front of everybody. That is in the program called E-mini Think Tank. Which of course you've got the links there for that. So I don't want to spend too much time on that. What I wanted to do though is kind of take a look at the markets and see where the heck are we going this year. 2022 was obviously very, very bearish, and we'll have to see how 2023 shakes out, but we can get some ideas of where we might be going based on price action. And that's what I do. I look at the current price action, and it really does tell me what is likely to happen in the future based on what has happened in the past. So just as an overview, and I'm using the futures here, we could always substitute the indexes if you choose. But with the futures, you can see the NASDAQ was the leader to the downside. It was down, let's go to cutoff at December here. There we are. So we were down about 29% on the NASDAQ from the beginning of the year. From the highs, it was actually a little bit worse. The market that was the most resilient was actually the Dow. You can see the Dow was only down about 7.6%. And then you got the Russell following with the S&P to the downside. So NASDAQ extremely weak. The Dow was a little bit limited. You got to be careful. That's not really a good measure of the broad economy. And the reason why, let me show you. I pointed this out before in certain workshops. If I go out to marketwatch.com, is probably the easiest way to see it. If you take a look at the diamonds, the ETF that tracks the Dow. So I'll go to DIA, and when I click on that, we can look at the holdings here. And what you see under holdings for the diamonds is that we are dominated by healthcare. Well, healthcare is not the biggest sector in the economy when it comes to the US. Really, it's financials. And that's number two. But the biggest problem that we have when it comes to the Dow is twofold. Number one, there's only 30 securities in the Dow. They really should call it the Dow 30 rather than the Dow Jones Industrial Average. And, the name, the industrial average, it's a holdover from when Charles Dow created way back in the early 1900s. But for the most part, it's got other sectors in it, and it's not really weighted very well to mimic the US economy. It also has a lot of international exposure. These are multinational companies that you're dealing with here. So that's one issue. The other problem is that these are price weighted. So United Healthcare Group is the biggest weight on the Dow at 10.42%, almost 11%. Problem is that's not representative of people's portfolios or even the economy as a whole, because it's not weighted properly. It's weighted based on price. The Dow, believe it or not, the Dow is the only index in the world, major index, is still price weighted. Everything else is market cap weighted, which means that the weighting is based on how many people actually own this in their portfolio and are trading it. And that makes a little bit more sense. So when you take a look at the NASDAQ, and we could do that by looking at QQQ, that is 100 different stocks. And with the holdings, you'll see the leader now for sector is technology. So again, not really representative of the US economy, because we are not a tech heavy economy. Our economy is really driven more by finance and really debt, to be honest with you. We're a nation of borrowers and creditors. But we can see that Apple is the biggest weight there, again, because of market capitalization. So if we want something that's a little bit more broad, we've got two choices. One would be the S&P 500. So you look at SPY, and under holdings, you can see that SPY still has heavy technology weighting due to Apple and its market cap weighting, as well as Microsoft, but it also has financials and a few others. Probably, and the one issue I have with the spiders or SPY or the S&P is, again, it's a little more weighted towards technology, and these are, again, international companies. So their revenue is not derived solely from the US economy, it's multinational. So if you really want to get a better gauge of how the US economy is performing, you actually want to take a look at the Russell 2000. First of all, it's 2,000 securities, so there's not one stock that really dominates like Apple does on the other indexes. Secondly, these are smaller companies that don't have as much international exposure, so they are more weighted based on what's happening inside the borders of the United States. And you can see with the weighting, number one weight is financials at almost 25%. Then you got some industrials, healthcare, and so on. So this is really a much better gauge as to what's really going on inside the US and the US economy. So in figuring that out and where the markets are going to go, first of all, this is not the leader right now on the weekly basis. And if we take a look at our most recent decline here from the beginning of December, I'll go to a daily time frame for this. So let's see, we'll pull this back. Right there, the end of November, beginning of December. You can still see the NASDAQ is still the leader with the Russell number 2 and the Dow. So nothing's changed as far as the weightings and what's pushing things around. But now let's go out to the markets. And you know what, I'm going to go here and enlarge this chart, and I'll bring up, let's see, we can probably do the index. Just got to remember what the symbol is for it, because I'm usually trading the futures. So I do a search on the Russell 2000, and actually we just go to index. That'll probably be even easier. Man, it looks like it's RUT. That'll work. And let me get this off for the order bar and a couple more things. There we go. And we'll go to weekly time frame. So there we are. Oops. Hang on. Why is that order bar still there? There we go. Much better. So here's the weekly chart of the Russell 2000 on, again, big time frame. And you can see that, again, since 2022 began, we were pretty bearish. And we actually started declining from the highs back in November of 2021. So if you start to measure from way back then, that gives you an idea of how bearish we were off the tops, off the highs. So yeah, IWM is the ETF that you want to kind of track for that. Right now, we are still down. Let's see if I can get percentage on this. They're going to give me the percentage. Oh, maybe I have to do it this way, using this tool instead. Edit. And let's see. Percentage. Yeah, you see it's down 27% off those highs for the Russell. And basically, looking forward, which is what we want to do, is figure out, okay, we're already down 27%. Is this the bottom? Have we seen it? Or are we likely to continue to move to the downside? Oh, shoot. Can't take that phone call right now. Getting called and interviewed by who's who in America. They want to put me in their book. It's kind of cool. Anyway, So getting back to the Russell, again, I'm going to go actually bigger picture. Let's go to monthly chart. And you can see on the monthly picture, we're very bearish. And obviously we can see we've had this big pullback. If we start to mark off where we came from and the moves, oh, thank you, Jennifer. And I'm kind of excited about it. So there we go. You can see we've had a pretty deep retracement already. As a matter of fact, I'm not going to put in every line. I'm just going to put in the ones that matter right now. And that is the 23.6% retracement value. That's where we bounced from already. Now, there's a possibility that we continue to go down further, obviously. You'll notice when I'm using Fibonacci's, I didn't go to the absolute low. I actually go from the beginning of the move, the open of the candle that took us higher. Or if it were downside, I'd use the open of that candle too, on the top of the red candle. So by doing that, I get a little bit more accurate data. And you can see that we've retraced 61.8% down to the 1637 area. And this is on the monthly chart. So we're looking big picture. We're not actually in a demand zone. We had a little bit of a bounce here, but there's a possibility of going a little bit lower. Okay, now it's going to take some time because honestly, we don't have momentum helping us to go down anymore. What we have here, this is an area of demand. That would be the bottom that I would predict right here. So new lows for 2023 versus the lows in 2022. However, we do have this monthly demand zone we're going to be running into that might hold us up a little bit. Now, remember, we're following the NASDAQ, so I might have to look at the NASDAQ to really tell where the bottom is. Okay, I'm kind of taking a step back here, but when I'm looking at the four markets, I do what's called follow the leader. And I teach this in my classes as well. When we're following the leader, you look to see, okay, which direction are we moving? Which market is leading us in that direction? So in the downward direction right now, we're being led downward, as I mentioned, by the NASDAQ. So how do we know we're bottoming out? The NASDAQ will tell us. That leader gives up and things reverse. Yes, Karen's mentioning that economic news was very good today. Yes, but good is bad, bad is good. What I mean by that is, yes, we had great numbers come out for the economy today, but I'll go back to Forex Factory here just to show you the unemployment numbers came out much better. We were actually at 3.5%. We dropped 1 point or 0.1% basically, and we actually had better numbers for employment. However, the problem is that's bad news because what that triggers is the Fed action. The Federal Reserve is worried about an overheating economy and they're trying to raise interest rates to slow it down. And that is cutting off the equity markets. So we basically reacted to that. Now I'll get back to the Russell in a moment here, but you can see the way we reacted this morning, for instance, on the S&P 500 was this. We had the news release and we exploded upwards, oddly enough, right into this level of supply that I had marked off and I tweeted about. So that's what we did. We went right in the supply and then turned around. Gave a second chance to get in. Since we've already tested that supply zone, we're breaking through it now, but we're hitting the next zone and stalling out there. So, yeah, the reason why the markets, again, they started to go up on positive news, but then sank down because of worries that the Fed was going to raise interest rates. And of course, it started rallying again a little bit, but we're not really getting out of our sideways range. And I'll talk a little bit more about that as well. But take a look at the big picture here, the 4-hour chart, you can see that we are pretty much stuck sideways, right? We've just been moving sideways for weeks. And this is not enough to get us out of it. Oddly enough, it's just not likely to happen. So we'll see where we're going to go from here. But getting back to the Russell, where I started my discussion, the monthly demand zone is a little bit lower. So I think we still have room to go to the downside. Okay. One of the things that I'm noticing, though, and the reason why I'm saying it's not happening right away is my momentum indicator. I use the RSI to let me know how much momentum we have in this security. And you can use it in multiple ways, but in multiple time frames. And you can see that on these lows, we just went below 40, which is kind of the bearish market cutoff. So we put in a low right here in price, and we went below 40. That's pretty bearish. We did it again. Went a little bit below. Actually, that one we did not go below 40, did we? This one was 39.69. This one was 40.12. So we did not go below 40 when we put in this low. And you can see as we came down again, now this is not a low officially. That monthly chart is not officially a low until you make a higher low and higher high on either side. But the problem that we're having is that we're not in bearish territory. And we're nowhere near bullish territory either. So this is suggesting that we're likely to go a little bit sideways, at least for the next couple months. We might be stuck in this range. I don't see any catalyst to take us out. Great question just came out. Charles is mentioning, will earnings this quarter cause further reactions to the overall markets? Yes, it will. The question is, are we going to be seeing lowered estimates, or are they going to be maintained? If the economy is starting to slow, one of the first things you'll notice is that a lot of the estimates for earnings will start to be lowered as well, so we can meet lowered expectations. And that's obviously another sign of weakness in the economy. So right now, I do see weakness here. We go down to the weekly chart, and on the weekly chart, again, we're seeing a little bit of struggle with being able to move down on the Russell, and this is suggesting more sideways price action. We basically have almost no momentum. If you stick around 50, there it is, that's 50 on the RSI. 50 basically doesn't measure, you're not getting bullish or bearish momentum. There's just nothing going on there. Basically, with this RSI, whenever you see the RSI rising above 50, that means the RSI is measuring bullish momentum. Oops, I had the caps lock on, I guess. I'll just leave it there. I'm going to retype everything. There we go. Hit the caps lock off. So RSI measures bullish momentum whenever you're above 50. And obviously then below 50, you're measuring bearish momentum. So if you're hovering right around 50, that basically means you don't have any bullish or bearish momentum. You're just kind of stuck. And that's what we're seeing as we're moving back and forth sideways. So we need to start seeing something with the trend. We got higher high, slightly lower low, now lower high. We don't have a lower low, we got higher low, so we don't have a trend either. We got nothing going on here as far as momentum or trend. So there's nothing happening as of yet that's telling us which direction to trade. Again, we're waiting to see maybe earnings in late January start to kick off a movement. Typically, when you go sideways like this, though, and I am on that weekly chart, when you go sideways like this and consolidate, you usually continue the trend that you were in before you consolidated. Well, the trend we were in obviously was to the downside. So that suggests we're likely to break to the downside. I'm also noticing getting kind of a symmetrical triangle formation, I think. No, actually, maybe it's just a descending triangle. We're getting about the same lows. Yep. So that is also a bit bearish. We're seeing we're making lower highs in general, but not the lower lows. So as we're basing here, it looks like we're getting ready to break to the downside. Once again, I think the earnings might be one of the catalysts we're looking for that move to the downside. So I can go down to the daily time frame, and even shorter term, we just don't have anything here. That's great. If we do try to break to the upside, we do have overhead selling pressure that's going to come into play. This is probably the first level right there. Yeah, a little drop-based drop. There's nothing else that hasn't been tested already. But moving to the downside below this line, there's really nothing back there to hold us up, which is another reason why I'm leaning towards the market's dropping. And I suppose there is a little demand right there. That's pretty significant. And then again, actually, that might be a retest of something back here as well. But overall, yeah, I'm still somewhat bearish on the markets. Now, the other thing we can look at is the NASDAQ. So if I go into my symbols and we'll go to NASDAQ, and I think it's going to be $NDX. Let me just take a look. Contains. Yep, there it is. So this is the NASDAQ 100. Once again, I can start off in the big picture, go to the monthly chart. Remember, this is the one that's leading us down. And you can see we had that big meteoric rise and, of course, that big drop that we're experiencing right now. And we stalled out at this monthly demand, but we ended up breaking through. So if we look once again, our move to the upside, our measured move. Oops, now I want to edit this. There we are. 61.8, there we are. Pretty much sitting right there at the 61.8% retracement. We kind of pinged off it and went through it. So that's suggesting we're getting more bearish momentum to possibly break down. The other thing I see on the RSI right here, let me just zoom in, it'll probably be easier to see it. Notice prices are making lower highs. We're also getting lower highs on momentum. So we're losing our momentum, but instead of going sideways like we saw on the Russell, where it's hovering around 50, this is actually hovering towards the 40, the bearish threshold. So this is suggesting that we're getting ready to break to the downside. And remember, the Nasdaq's been taking everything down. It's likely to drag the rest of the markets with it down to the next level here at about 9,000. And that's going to be catastrophic for a lot of people. If we break that 5 digits under 10,000, psychologically, that's going to be a huge in the face, so to speak, when it comes to investors. Let's drop down to the weekly chart and see what's going on there. Pretty strong bearish trend, right? You're still seeing lower highs and lower lows. We had a small interruption with what we call a positive divergence here. You can see we made prices made a lower low. However, momentum did not support that. We had a slightly higher low with momentum. And now we're struggling to get below 40. You can see we're getting buying pressure on the candles as well. You know, as mentioned, price tells you a lot. And if you know what to look for, it can really tell you a story about the markets. So with these candles, the shape is a very important thing. One of my lessons I teach often in E-mini think tanks and my other programs is reading price. Now, I'm not going to go into all the details right now, but in order to read price properly, there's really 4 main things to focus on. One is color. Okay, do you have a dominance of color that can help you with the trend? Another is shape. Another is size. And finally, location. Like I said, I'm not going to go into detail too much right here, but I will talk about shape real quick. And basically, shape, you're looking at the closing price versus the high and the low. Okay, that's what you're looking for, that closing price versus the high and the low. So basically, I call it the tail of the tails. I used to write articles. Actually, I'm writing more soon, but I call it tail of the tails. And basically what it comes down to is any price action from the low to the close is buying pressure, right? Because if you couldn't close at the low, buyers pushed you off those lows. So you see the bottom wicks or tails, that's indicating buying pressure. And you're seeing on the candles that we're getting recently, last 3 weeks right there, we're getting a lot of buying pressure on the wicks. That's bullish. Well, conversely, if we have any price action above the close, so in this case, any price action above the close is bearish. So basically, it's from the high, you know, oops. Come on. Or topping tails. So a green candle could be bearish or a red candle could be bullish depending on the shape of the candle. For instance, this little red candle right here, that's a very bullish candle, right? You see that big bottom tail, and sure enough, we paused right after that candle. Now, we went a little bit lower, but we broke up our downward trend because buying pressure came in while we were moving down. So sometimes it's a little more obvious. You know, for instance, here you see that big buying pressure candle, it's green. Next thing you know, we stopped moving down and had a nice retracement. Okay, well, it also corresponded with buying pressure back here in the origin of that rally. So it shouldn't have been much of a surprise. But other times it can be. As a matter of fact, right here, you can see we're moving up. Notice what kind of pressure do we have there? Big topping tail, right? We close very far away from the high. That's selling pressure. And that's suggesting that we're not going to be able to continue to go higher. There we go. Buying pressure coming in. We're probably near a bottom or at least a pause. And that's exactly what happened. And again, the markets like to tell you where they want to go. You just got to pay attention to it. So currently, if we go to the end here, you can see we've got a lot of buying pressure candles. They're small though. So this is more or less a pause rather than a big, strong move to the upside that I'd be expecting. Okay. And now let's go down to the daily time frame, get a little bit closer picture. Well, if we do rally, we do have, this is a really good supply zone right here. Kind of drop, base, drop with follow through. Might not be able to make it that far. We might end up stalling out right in this 11,250 area once again. But like I said, for 2023 so far, what I'm seeing is more bearishness to come. Looking at the weekly chart of the NASDAQ, if we're trying to find where this might be headed to, we do have that monthly demand at 9,000. And even here on the daily time frame, excuse me, the weekly time frame, we still have a zone right there at about 9,000. So that looks like a really good downside target. The question is, when will that start to move? You just got to watch. It could be earnings, whatever starts to cause more bearish pressure. That'll be our trigger to start breaking down. Do I play those like hammers and shooting stars? Yeah, I mean, I don't care about the names of the candles or the patterns that way, but I do look at the shape and I trade them as such. So yes, if I see something like this, for instance, zoom in here a little more. Here's price falling down. Okay, we were in a nice bullish trend. We start pulling back a little bit, and I'm left with a bunch of buying pressure on that candle. Of course, location is a very important piece of this as well. And this location happens to be an area of demand. You have drop, base, base, base. There's your rally. So right now, here I am faced with buying pressure in the area of bullish demand. That's likely to go up. And sure enough, another one came in. There, we finally got confirmation. We broke to the upside and continued to go higher. So yeah, you can use them as you would the patterns. But I don't need to memorize all the pattern names. I just need to know what to look for: color, shape, size, and location. Okay. So that's what I'm seeing so far in the equity markets, that overall, we are not done with moving down. Another thing that helps to confirm some of this is looking at sector rotation. Go out to a website, stockcharts.com. I've been using this for years. You can take a look at, there's a free tool here called performance charts. And I like to use this S&P sector ETFs. So looking at this, we've got all the ETFs that track the various sectors. We've got discretionary, consumer services, technology, and so on. If you scroll down a little bit, you can see orange is the stock market and blue is the economy. The stock market always leads the economy because we are speculating as to the future of the economy. So what you can do here is get an idea of where the markets are currently and where they're likely to be going. Well, we take a look at roughly the last 6 months. And in the last 6 months, obviously, very strong sector here, you're seeing energy. Now be careful, because right now, the way this defaults and is set up, it's showing you how those sectors are performing in relationship to the S&P 500. So if I take out the S&P 500, that's how the sectors actually performed. It can actually make a big difference at times. So right now, if we're trying to figure out where in that map that we are, we look to see, okay, where would we be if we have leading energy as our leading sector, followed by industrials? Well, by looking down, it looks as though right in here, industrials, materials, energy, that is near or following the market peak. And that's in expectation of a recession. By the way, this lag time between the market and the economy is roughly 3 to 6 months. It's not exact, but it's kind of that area. So that's suggesting that we are at a market peak. Obviously, the markets are way off the highs, but this has been going on for quite some time. So it suggests that there may be leadership rotation into consumer staples, healthcare, and utilities. So now think back, okay? Healthcare, that's supposed to be one of the leading sectors when the market is going into a slide. Well, what was the strongest index recently? Remember, we had the 4 major indexes. S&P, NASDAQ, Dow, and Russell. The Dow was the one that held up the most. What's the leading stock in the Dow? United Healthcare. Makes sense now that the Dow was leading, doesn't it? So it's kind of confirming this, that we're seeing some leadership now in healthcare. If we go not 6 months, but we go a little bit less than that, maybe the last month, you can see everything's down. But some of the better performing sectors, if we go back just a little bit here, where am I at? November 17th, October, kind of that. That's not exactly showing the picture I was looking for, but you were seeing a little bit better performance in some of the healthcare and staples. And again, even the last 22 days, last month, there's a little bit of movement. Utilities are holding up well. Financials, for whatever reason, are holding up well. But you actually saw healthcare and staples doing well. And you would expect that to continue. I'm not saying that those are the sectors to buy. Again, this is how they're performing versus the S&P 500, or against the S&P 500. Excuse me. So if you take out the S&P 500, they're all going down. So I'm not saying to buy those sectors. I'm just saying those sectors outperforming can give you an idea of where the market bottom is. And we have not hit the bottom yet. As a matter of fact, we're still pretty close to the high in the market. That's all it's saying. Look for the chart on screen below. Well, there's other things you can look at. Yes, interest rates, things like that. But according to this, I mean, it varies month to month. Obviously, things are moving around quite a bit. But overall, when you start looking at bigger time frames here, a few months even, and you can adjust this, just drag it out a little bit. All things that I'm seeing are pointing towards us being near this area right here, where the market has peaked and is falling off, but we are nowhere near the bottom. Now, you want to talk about interest rates, you can also go there too. This is a great website. You've got, where is it? Gotta find it now. There it is, dynamic yield curve. That's another thing you can look at. Now, one of the things that concerns me when it comes to interest rates is this. January 5th, this is showing what's called an inverted yield curve, meaning long-term rates offer a worse yield than short-term. Nobody wants to buy those. Okay, the reason why is they're expecting a drop in the markets. Every single recession that we've ever had has been preceded by an inverted yield curve. But not every inverted yield curve leads to recession. You got to be careful there, okay? So when you get inverted yield curves, you might have a recession. You go back to the big crash here in 2007, 2008, and we started going inverted. It actually shows inverted at one point. I don't remember exactly where. It was brief. There it was, just flashed. So there we were in 2006, inverted before the big crash. And if you keep going back again, inverted yield curve right there. That was in April of 2000 before the big crash in the tech industry. I mean, for the stage where energy and, the interest rates don't confirm it. Right. Yeah. Because, well, the problem with the interest rates is that the Fed is late. They are always late. Interest rates should be going up much higher than they are right now because cut off inflation, right? Because the energy and industrial should be booming, or were booming, because of the inflation, and the Fed should have been raising rates. They are very, very late, and they always are. So anyway, that is a very bearish sign for the economy right there, that inverted yield curve, plain and simple, suggesting that we're not done. We haven't seen the recession yet, and we're likely to continue to move down. Going back once again, the other thing I was looking at is under this. I'm trying to remember. Intermarket study, I think it is. Yep. So here's another thing you can look at as well. Speaking of the interest rates, commodities, and things like that with bonds, right now we're looking at a chart that shows us the S&P 500 in red, the commodity index in blue, US dollar in green, and the bond prices, not yields, in pink. Keep in mind, bond prices and yields move opposite of each other. It's like a seesaw. Okay. So you scroll down a little bit, it shows the relationships. There's an inverse relationship between bonds and stocks. There's a positive relationship between stocks and commodities. Okay. So you can take a look at where we are right now, where we might be going. And what it's showing us right now is obviously the red, stock market's moving down. Bonds usually move opposite. They were moving a little to the upside here, but started to fall off recently as well. So you're right. The interest rates are not necessarily confirming everything that's happening. And that's because the Fed is reacting very, very late to the stimuli, and they always play catch up. Okay. And then they overdo it as well. It's historic. It's been that way for years. So overall, it looks like the markets are still ready to continue to move to the downside. So you still want to be somewhat protective, and it does look like inflation is still a problem. I was trying to remember, there's another site I was going to take you to, and I forgot now. Oh, well, I'll think of it later, I'm sure. Oh, I know one other thing I wanted to look at was this. I could probably do it here in TradingView. I go out to my charts. One of the things you can look at, if I go back to the sector rotation here, what's kind of cool is you can look at the extremes. Typically, consumer discretionary is very bullish when the markets are going to become bullish, when you're near the bottom. Consumer staples, that's a safety valve. That's where money goes when people are afraid of the markets collapsing. So they're at two extremes. And you can use other extremes if you wanted to as well, but those are two of the best. If you've got extra money, the economy is doing well, people spend on discretionary items. But if money's tight and the economy's tight, then they only spend on staples. So if you create a chart, let me see if I can do this here correctly. I'll bring it up. We'll do it on this one. If we want to bring up a chart of XLY, which is discretionary, divided by XLP, see if that works. Yep. Weekly. There we go. So basically what we're looking at is one divided by the other. So oops, let me clean all that off. And what this shows us, and actually what I could do is this as well. So let me delete the RSI, and I'm going to bring in, we might change the percent, but let's try this anyway. I was going to bring in the S&P 500. So compare it to SPY, there we go. And you can see they're very, very similar. It makes sense, right? Because if basically what we're charting is the consumer discretionary versus consumer staples, right? This is XLY, which is discretionary, divided by XLP, which is staples. And basically, if the chart is moving up, it's bullish for the stock market. If the chart's down, it's bearish. I can spell today for stocks. Now, this is not exact, but it's pretty close. And it can give you a good indication as to which way the markets are likely to keep moving. So we're seeing right now, big decline, obviously, right? And if you put this either weekly or monthly, again, like with the S&P 500, it can sometimes lead and give you an idea of when the markets are changing trend direction. So until we break our trends, we're likely to continue to see, because right now the market's going down or chart's going down, that's bearish for the stock market. So if we start drawing in trend lines, until those trend lines are broken, the trend is likely to resume or continue. I want that. There we go. So again, this is pointing towards continuation of the downward market until we start to see this bottoming out. And the momentum is very strong too. If I go back and add in my RSI that I had there before, strength index, there it is. We've adjusted a little bit here. I use 60 and 40 for this. There we go. And there. Perfect. You can see that we have plenty of bearish momentum continuing down. But what I would look for is signs of change, things like this. You can see we were moving in a strong bullish trend a while back. This is going into 2021 in November before the markets dropped. And we had a nice little bullish trend developed here. Probably extend it off to the right. Extend right line. There we go. And what was happening at this point was a warning sign. And this is what we'll look for the bottom too. I'll show you how to find those. But right here, you can see prices were making new highs. But the momentum wasn't there. Look at this. I mean, you could chart almost anything. It works the same way. So right there, that's a warning sign, a negative divergence, and a possible drop that was coming. And then we broke the trend. There it was, December of 2021, telling us that the trend was changing. And there we go. Down, 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 down. Now, how do I know when the bottom is being put in? Well, obviously, if we can break this downward trend, that's a good sign. Number one. Number two, we could also look for a possible bouncing point, area of demand, or we can look for what's called a positive divergence. And looking back, let's see, we don't always get these signals, but often we can. You know, for instance, looking at this little decline right here, we didn't really get a divergence. We made higher low on both price and the indicator. So how do we know we're changing trend direction? Well, sometimes you just got to draw a trend line. And if you see it being broken, unfortunately, this was only two tests. I don't know, what's three? 1, 2, 3. Let's see, hang on. Right there. 1, 2, 3 touches. You need 3 touches for an actual trend line. If it's not 3 touches, it's not confirmed as a trend line, because you can draw it off 2 lines on every 2 candles. But right there, we broke that confirmed trend line. That was the end of the downward trend. We never got any other warning, unfortunately, and we turned it around. So if we go back in time, historically, let's see if there's another bottoming that we could find that gave us a warning. Because we might have that kind of break of the trend and nothing else. Again, I'm trying to figure out what might tell us when we're bottoming out. We haven't seen it yet. So right here, again, we have 1, 2, 3 touches. As soon as we broke that trend line, we didn't have any other warnings yet. The only other signal we had was right here. And the reason why we had another signal here, notice we have a low, higher, high, higher, high. That's an uptrend. So we're becoming more bullish. Oh, we broke it again, wasn't finished. In this case, it's not showing my numbers, but we did put in a low right here that's above 40. And that was also a bullish signal. So basically what I'm going to look for with this indicator, are these calls recorded somewhere? What do you mean, these calls? Are you talking about this webinar? Is it recorded? Yeah, it's going to be on YouTube on our Wealth Builders HQ channel. So you'll be able to review this. But basically what I'm going to look for signals and a bear market signal. We have a couple. Okay, so for one, the trend line breaks. This is, again, the XLY divided by XLP. That could lead us by maybe a couple weeks, potentially. Okay, there you go. You got the link. Miguel put you there for the YouTube. Another one would be what's called positive divergence. And that would be if price makes lower lows, but the indicator makes higher lows. Okay. Or low in price, but the RSI is greater than 40. And finally, if the RSI breaks above 60. So any one of those 4 things would be a signal to let us know we're putting in a major bottom and we're probably going to come back to the upside, at least sideways, if not back to the upside. So that'll be one of our clues to let us know when the markets are bottoming out. And of course, where's it likely to happen? Probably when the NASDAQ hits 9,000 or around that area. That's where we had our demand zone. So that's what I'm expecting. I see more bearishness this year. We're still stuck in the sideways action, and we'll know we're moving out of it when you start seeing that trend developing again, where we can break out of the sideways basing that we've been in for a couple of weeks. It's not so bad on the NASDAQ. NASDAQ has actually been a little more bearish. But again, if you go to the S&P, you see SPX, there we go. You can see just really tight and sideways there. That stinks. It's not a lot of fun to trade unless you're scalping back and forth on the intraday. But overall, the markets are just continuing to look to move to the downside, and that's what I'm playing it at. The other thing I do follow a lot of pay attention to is the seasonality of the markets. And this is something I've talked about more in my Wealth with Spreads program. And the reason why is when we look at spreads, and you'll see if I go out to, let's see, Wealth with Spreads. Actually, I think I have it open right now. But I put out a video and I talk more about how to trade these. There's actually right here, educational videos, how to trade the spreads and what they are. But I also have certain documents where you can download, I think it was right here, trade ideas. So I've got these trade ideas I put out once a week. And if you take a look at some of the results, you can actually download the spreadsheets. Let me just show you real quick, though. I got a couple of them open, I think. And maybe not show you the current one, but I'll show you. Yeah, we can look at November's. Most of those are closed. We still have a couple more open trades left. But the reason why I bring that up is seasonality is a big thing when it comes to these markets. I play it a lot more on spreads than I do anything else, but you can trade the seasonality of pretty much any security. Every security goes through different seasons where they're sometimes bullish and sometimes bearish. So looking at some of these trades that we identified in the past, come on, there it goes. You can see gasoline or euro dollars, heating oil. What I'm doing is simply trading one contract versus another. And spreads are very, very seasonal. And they follow through predominantly because big institutions are trading them and they follow that as well. So I bring that up because if we're looking at big term, what's likely to happen in the markets, we can actually go out to, and I have a couple of different resources here. One is MRCI that I like to use. Bring that up. Another one is SeasonX. Oops, MRCI does that recently for me. I don't know what happened there. Anyway, MRCI online is actually not that expensive. It's about $341 a year if you use my discount. There's a MRCI.com 10% discount. Basically under source, you got to put in the word wealth and my name. There you go. So if you do that, it'll give you a 10% discount, makes it $341 a year if you're interested. Looks like a lot of pressure on the SPX. It looks interesting when it breaks, what direction, how far. I'll go over that. I do think it's going to go down. So anyway, right here, if I go to future seasonal patterns, we go to indices, and you can see right here, S&P E-mini, they have the index. Well, we can also look at the individual futures. I'm just going to go to index right there. And for the S&P 500, you can see they're looking at the last 5, 15, or even 30 years history. And it gives you an idea of which way the markets are likely to go. Well, the beginning of the year, in the last, say, 30 years, we'll start off there. I'll do one at a time. In the last 30 years, not been so great, has it? January has been kind of a month, just back and forth. So we don't expect any real bullish activity until late January, early February. Let's see if that's changed over the last 5 years. Well, last 5 years, we had a little bit of a rally and then a sell-off to the end January, and then we get into our bearish time of the month, or months, sorry. We have several months here that look pretty bearish in the S&P. So that's suggesting we may not see a bottom in the markets, perhaps until late March, early April, if it holds true the way we've been moving for the past 5 years or so. Last 15 was a little bit better. We bottomed out in late January, just like the last 30. But this is kind of interesting that it looks as though we might see a little bit of choppiness between next week and until February. And then we'll sell off, finally bottom out. So what is that telling me? Again, I'm looking at the S&P 500. So let's go over to that index here. I'm on the S&P. Again, we can go to a weekly time frame here. You can see we're still making lower highs, lower lows, right? Actually, let's go bigger. Let's go monthly. Tesla, yeah, we can take a look at markets. So anyway, looking at the S&P monthly, we did hit a monthly demand zone here. And we did hold above 40 on the RSI. That's the only thing so far that I've seen that said that we might be already having our bottom put in. Okay, on the other markets, we didn't have that. Remember, the NASDAQ is our leader to the downside, pulling everything down. That doesn't have demand until 9,000. So we could, again, go into this demand and basically penetrate it deeper. Be interesting to see if this holds or not. On the weekly time frame, if we're looking for a little more detail, again, we're getting lots of bearish pressure. However, the last few candles, bullish. Remember, closing off the lows, it's bullish pressure coming in. And not only do we have bullish pressure, but you can see this is the first time we haven't put in a low yet, but we're close to putting in a low, and we're not anywhere near or below 40. Look at that. Every time we came down, we were going below 40. So we tried to rally up, failed to make new highs, started breaking down, rallied, failed to make new highs, started breaking down. But now we're not getting below 40. That's actually somewhat bullish. So if we break out, there is a possibility of rallying to the next weekly supply. Now, the NASDAQ would actually have to help you with that because the NASDAQ is dragging everything down. Okay, I'll take a look at that. Absolutely. You can definitely email me there. Yeah. Bollinger Bands can help. Yeah, I definitely use Bollinger Bands from time to time. You know, if we go here, and I'm on the weekly chart looking at the Bollinger Bands, you can tell Bollinger Bands help you when you're oversold. You see, typically you go back up, or if you're overbought, you often will drop. They're just technical indicators that can help out, but you got to be careful with how you use them because a lot of people try to sell as soon as they become overbought. And the problem is that's a trend. You become more overbought. So you got to use them properly. You're looking for a change where if you're very, very bullish and overbought, if you start falling off the highs and close below, then you're no longer overbought. You might be reversing and moving down. The problem with the Bollinger Bands, you have to wait for that close. So you're always going to be late by at least one candle. That's the one thing you got to be careful of. So again, going back here on my other chart and weekly, again, we have this rally point right here, a supply zone we might be able to get up to. Get rid of the order bar here. There we are. I hate when this keeps jumping. And deleted it, of course. But yeah, I use Bollinger Bands quite a bit actually on my spread trading as well. But you can see that if we do rally, what we need to do in order to put in a low, this is the candle that we're watching right here. That one. Okay, that's the lowest low. You have a higher low and higher high on this side. We do not have a higher high yet on the right side of it. So if we do continue to make higher lows and finally make the higher high, this becomes confirmed as a bottom or a low, and it's not below 40. That would be the catalyst that should drive prices up to the supply. Now, will we be able to break through? I don't think so. I think we'll end up turning around back there again, but then we'll be in a bullish trend, and that may be the bottom of the markets that we saw. So if we do end up putting in a higher move in the S&P above 38.89, look again, you'll see that this is above 40. What should happen if we can break above 38.89, we don't even need to close above it, just break above it, then we should be able to make it move up to 42.18. But seasonally, it's not supporting us, right? This is our little bit of bullishness that we typically get in early January, but then everything starts to fall. And if the NASDAQ drives back down, you know, if we break the lows of this candle and make new lows, then all bets are off. We're going to continue dropping here on the S&P as well. We've already tested this monthly demand. We could go a little bit lower. Matter of fact, there's no weekly demand. That's not a good zone. Maybe way down here. I don't see us getting that low, but it could get that bad. If the NASDAQ starts dropping more, the S&P should drop to about 25.61 this year. And that would be the low that I would expect, that area. Okay. And again, going back to the NASDAQ, that's the market that's telling us which way we're going to go. And as of right now, clean this up a little bit here. We are struggling to go down more. And we can take a look at the seasonality there as well in MRCI. I forgot to bring in the other tool, but I'll do that in a moment. So NASDAQ, there it is, index. Let's take a look. The NASDAQ has been a little bit more bullish during January for the last 5 years. The last 30 and 15 hasn't been as much, but it takes a severe drop in mid-February. So look out for that typically. So SeasonX is my other tool. I've actually got 3 different tools I use for seasonality because I follow it quite a bit. MRCI is the easiest one to use and the cheapest one. Like I said, is only $341 a year with the discount. This one's a little more expensive, but what I can do here, it's pretty cool. Yeah, we'll do NASDAQ. Now I can go individual dates. So here we are. Today is what, 6th? And we can take a look to see. Let's go to the end of the month. There we go. You can see that for the last 10 years, the market went up 70% of the time, but only by 1%. So not a huge potential move, but I like to look a little bit longer. Typically, I forgot to change this, 15 years. And for the last 15 years, look at that. It's actually a little bearish. Average return was negative for the NASDAQ. And it was only up 60%. Let's take a look at the S&P. Remember, that was the leading market, and it looks like the markets are going to go down. On the S&P for the last 15 years, the markets actually pick it. Half time goes up, half time it goes down. The average return, however, was bearish. So that's suggesting that we are going to fail to rally and go sideways or down for the next several months. That's what this is telling me right now in the markets. So as a request, I had a request come in for Tesla. I can take a look at that real quick for you as well. But overall, it does look like the markets are going to become a little bit bearish. And as far as Tesla, it looks like we got earnings coming up. One's at 124. This looks pretty ugly. Let's see. I'm on a weekly chart. Let me go to monthly for a moment. Yeah, monthly, we've already broken demand. And you can see we are below 40. That's very, very bearish. Go to weekly, same picture. Lots of bearish pressure. Looks like it's slowing down just a little bit on the move down right now, but doesn't look like it's going to stop. So again, looking back, we have rally base rally that we're in as far as weekly demand, but this is not going to hold. So our next stop on Tesla, yeah, probably that 67.47. And I don't even see any kind of move to the upside at all. There's just way too much bearish pressure here. Going down to the daily time frame. Okay, now we're getting a little bit of a reprieve. Prices have been moving very, very strong to the downside, but you'll notice we're getting a few green candles coming in and the momentum is dying off. So we have a positive divergence. That's usually where you get a little bit of a pullback if that's going to happen. So let me zoom in a little more on this. Now we can get an idea of where it might pull back to. I don't expect much out of it, to be honest with you. I would say, yeah, right here's probably where to start. And looking at our retracement values. There we go. So we can pull back, and most likely, I would say a target for me to re-engage the bearish trend short would be right here. That's 135.89 to 141. You got the 139.10 Fibonacci retracement of 50% right in the middle. That's a good shorting opportunity. And then your target would be that weekly target that I had for demand just above 67.47, so 68 probably. So that's kind of what I'm seeing there for a trade on Tesla. And guess what? We can take a look at the seasonal move on that too. This is pretty powerful, right? Let's see, how does Tesla usually perform? I guess we got 12 years of history here. So 12, 13 years. And it looks that 6th, let me just go to the 13th, next Friday. And it's been pretty bearish, almost 70% of the time. We've seen drops of about 1.23%. And if we're looking longer term, it doesn't look much better. So it looks as though that this might be a good trade opportunity for short. Again, that 135, 136 to 141 area, targeting 67.47. That's a pretty good drop, almost 50% drop in price. So another question, do I think Bitcoin will have the same correlations I have with the S&P? Will it break away and go on its own? I think Bitcoin's kind of dead right now. As far as correlations, I don't think it really has any, does it? if you take a look, let me see if I can show you maybe here. Oops. Or go in. Where do I have it? Just want to make sure. XBT, there we go. You can see it's just kind of sideways right now. This is a weekly chart on Bitcoin, not really going anywhere. So I don't know. I mean, maybe it has a little bit of a correlation. Let me clean this up. If I compare it to, I'll do compare it to the futures. Continuous contract. There we go. And let's see, we're percent change chart now. So let me change this to a line as well. And then instead of the RSI, if I bring in correlation, there we go. Yeah, you can see that we've completely lost correlation here. There was never really great correlation, I would say. I guess there were pockets of it where, yeah, it was actually 90% positive correlation, then it went negative for a while. So this is the correlation of Bitcoin versus the S&P. And right now we have no correlation. So could it be breaking the opposite way? It has before. So we're definitely at almost no correlation right now. It's a 23% negative correlation, which is not very strong at all. Could it go stronger? Possibly. I don't know. And honestly, to me, I'm not really interested in trading Bitcoin right now because it's just, it's dead. There's not really much to do with it. It's gone sideways. We're stuck in this area of demand that I was looking at not years ago, but yeah, I guess it's been about a year or so. That was been my downside target for a while, and it's just stuck there. So I don't know. I mean, yeah, I just don't see it going anywhere. Oh, the correlation chart? Yeah, absolutely. Tesla has news that's driving it back. People think 100's the bottom. I don't know. Like I said, I look at the charts and see what the charts are telling me. And right now, there is a bit of weakness in this downward move. I guess people are trying to buy it right around 100. You can see the momentum is shifting slightly, but overall, it's still extremely bearish. This is a daily time frame. Going to the weekly, the trend is still extremely bearish, very strong. There's nothing, well, I shouldn't say nothing telling me it's going to rally because there is a little something here. You notice the candles at the bottom tails. As we learned, that's a bullish signal, right? So we're getting the bottom tails telling us we might get a little bounce in Tesla, but because we have so much bearish momentum, it's not going to be very far. And that's why I have that upside target right here. Delete that. There we go. And again, I'd be looking to short this if it gets to 135. So could you buy from 100 to 135? I don't know, perhaps. I just don't have a good demand zone to get in. I'd wait for that. Okay. So unfortunately, I got to get going here. It's been about an hour. This will be recorded, or has been recorded. And as mentioned, you can join us as well on our YouTube channel. If you go out right there, they put Miguel put in the link earlier. Let me see. Did it go? Yep, there it is, Wealth Builders. And if you go to the videos, sorry, or playlists, either one, you'll find the Trading Coaches Playbook. So Ryan Litchfield's done a bunch, Tony does a bunch, I do some. So yeah, you'll find them there. And again, play it safe. There's a lot of volatility going on right now. Speaking of volatility, I think the VIX has changed a bit too. Let me see, $ VIX. There we are. And where are we right now on the VIX? I just want to check that out real quick too. Long-term picture still very, very low. And VIX, or volatility, usually moves opposite of the markets. So we are at the low end of the sideways range, which usually leads to a boost to the upside. When that move up happens, the stock market usually drops. So this is all pointing towards more bearishness to continue for 2023. Which I'm not saying that's a bad thing. If you know how to prosper in bearish markets, that's actually a great opportunity. And if you don't know how, make sure you learn. Because again, it's a great opportunity. So yeah, there's a lot of stuff. Again, you can definitely watch the recording. FCX, let's see, do I have time real quick? I can do that, I suppose. FCX, Freeport McMoran. That used to be a leader of the industry. And I guess what's happened there? Is that good data? No, I'm missing some data here for some reason. So let me go to a different chart. Clean this up. Oops, get rid of this correlation indicator. I don't need that. There we go. And I will bring in my RSI though. There it is. All right. So that being said, let me see, make a couple adjustments on it real quick. I'm going to finish up with that because I do actually have to go. But all right, 60-40, and we're good. All right. So looking at Freeport McMoran on the weekly basis, we have a bullish trend. This had a nice little, not really divergence. We had higher lows on both price and the indicator. So we're in an uptrend right now. You see what the monthly looks like for a moment. Looks like a giant head and shoulders, doesn't it? It's not really sloped the right direction, but you have left shoulder, head, right shoulder. Kind of interesting. That's on the monthly. Yeah, I don't see it following through. We are definitely losing some momentum there. Now we go down to that weekly again. Whoops, wrong one. 1 week. And on the weekly, it looks like we're at supply right now, but we have enough momentum that we should be able to push through it. I don't see us turning around here. What I was looking at is right there. You have rally base. There's your drop for the supply. But again, we've been there multiple times and are pushing through it. So it looks as though FCX should continue to move up towards the next weekly supply right there at about 48.72. And going down to the daily time frame, let's see if we got anything else here. Yeah, it's just still very bullish. Be careful. Don't chase this. Oh, hey, Mario. Glad to see you in here. I haven't talked to you in a while. Thank you, Charles. But anyway, looking at FCX Freeport, you can see that we had this big gap up. I don't know if that was earnings or news. Chinese stimulus plan lifts demand hopes. But you got to be careful. A lot of people chase price right here. Okay. And I'm not sure if we got volume in that too. Let me take a look. No, not really a spike in volume. That's good. Because if you get a spike in volume, then they usually get a reversal. But what I don't like is we broke out here with with that big parabolic move and the gap up. Usually you'll get a nice retracement before you go higher. So there is an opportunity on the pullback to buy before it gets to 48.72. So look for that. If I drop down to a 4-hour chart, I don't know if that's going to be a good entry, but there may become a zone here, 40.26 to 39.59. And again, that upside target, you want to get out before you hit that 48.72. So maybe 48.30 or so, get out ahead of it. But that's what it looks like. It looks very bullish for this. One of the other things, again, I can look for is the seasonality of Freeport McMoran and get an idea. What's it likely to do? Well, guess what? Seasonally, it looks pretty bad. Wow. 87% of the time, it drops over the last 13 years from, for January, basically. So this may not be the time to buy it seasonally, although what does copper usually do? Because this is obviously a play on copper. Copper is also somewhat bearish. So you may want to hold off a little bit on trying to buy this, wait for a nice pullback before you go long. Might be a false breakout here. I don't like breakouts. I wait for the pullbacks before I go long. And there's another zone just below this as well on the 4-hour right there. So I want to thank everybody for being here. Again, if you want to hang out with me more, I'd love to have you in the E-mini think tank. We got plenty of opportunity where we learn about the futures markets and trade them 3 days a week live. If you're swing trading more into that, we have the Wealth with Spreads program as well. You can join me there. If you got more questions, let us know. You can contact us at support@wealthbuildershq.com. I'll put the email up there. So if you didn't get your questions answered or you have more questions, please hit me up at support@wealthbuildershq.com. On Twitter, you can also find me at TraderBDub. Okay, be careful because there's other ones that are trying to copy me. So anyway, I got to go. They're calling me back on the who's who. I guess they want to interview. So thanks again for being here. Trade safe, trade well. Take care, everybody.